We meet in an hour of change and challenge, in a decade of hope and fear, in an age of both knowledge and ignorance. If this capsule history of our progress teaches us anything, it is that man in his quest for knowledge and progress is determined and cannot be deterred. Because that goal will serve to organize and measure the best of our energies and skills. Because that challenge is one that we're willing to accept, one we are unwilling to postpone, and one we intend to win.
So we are here today with Brooks Klimley, who is an adjunct professor of international affairs at Columbia University and also the president of his own consulting firm as well. We're here to talk today on the topic of project finance. Brooks, welcome to Energy Impact.
Thanks very much, Brett. Glad to be here. Look forward to the conversation.
Absolutely. So let's just get started first by establishing, who you are, what your history and career has been like. How did you ever even get into the finance world, at the very beginning?
That's interesting. I went to Columbia as an undergraduate and then spent a couple of years in England studying a fellowship, came back, was going to go to law school, got married, and decided maybe I'm going to get a job. So at that point in time, this would be early 80s, I looked around, talked to a bunch of the banking firms, and joined at that point Chemical Bank, which is a predecessor of one of the roll-ups in JP Morgan. And at that point in time, the energy business was, evolving very rapidly. You were post OPEC, things that historical norms and the like were being unwound. And so when I came off the original training program, you were going to go work someplace, and I decided that the energy business was probably about the most interesting one out there. And it's very different because the assets are different, the way people look at it is different. And so I sort of raised my hand and said, I'd like to join the project finance group, which is this very sort of esoteric specialization, and they've never taken a junior person. I said, I get it. And, if it doesn't work out, I understand. And it was just kind of the right time to be there because you had one of the first big oil crashes. And so Bob Horton at BP came out, so the oil prices were going to $5. And I inherited sort of these boxes of documents about all these project finance loans, which I knew nothing about. But somebody had to kind of muddle through it and figure out, what's actually going on and, what recourse is there and the like. And I had some fledgling knowledge of this thing called a personal computer that was new to the scene. And so I was able to model up things. I mean, this is about as rudimentary as you could be, but it was pretty clear that the banks had taken positions based on, very technical analysis of oil and gas reserves in the North Sea and this very elaborate tax code that would allow them to get very comfortable with the cash flows from the reserves and not worry too much about the entity that was taking the debt out, et cetera. So it was real non-recourse, project finance, asset-based, very granular analysis.
Can we double click on that for a second? Non-recourse. What does that mean in the project finance world, the term non-recourse?
So when you think about a project, you're actually, as a lender, you're lending into a entity that is ring-fenced. It's enclosed in and of itself. So it can be owned by someone, but you don't have recourse to the owner. So take an oil and gas project or a mining development project.
And what is recourse even?
Recourse is that's actually who you can pursue the credit with, if you will. So if there's a balance sheet obligation on an energy company and it's directed to a project, but it's recourse to the parent, then if the project doesn't work, the lenders can go back and say, okay, I'm now coming to the company itself. I have recourse from a credit standpoint.
I see. So recourse means a way to get your money back. You invest in something and you want to be able to, if something goes wrong, be able to salvage something out of it. That's what recourse is.
Exactly. It's who you can go to above and beyond the investment you made in the project itself.
Okay.
So when you think about projects, the reason the banks are comfortable with them is there's a tremendous amount of technical diligence, tremendous contractual review to make sure that the environment, both the state, the local, the federal level, is all in place. Contracts for the offtake, contracts for the inputs, and then they're very comfortable saying, okay, based on these contracts, including the most important one, which is the EPC contract, that is, big engineering firm will stand up and say, I will deliver this project on time, on budget, and on spec.
Yep.
With all that's in place, the banks are comfortable that they're taking risks that they know are either laid off to somebody like the engineering firm, or that they can get their hands around.
Okay, and you mentioned three terms there that I want to break out a little bit further for our audience. You mentioned offtake, and the offtake is who is saying that they're going to purchase power from you. They're off-taking the power. They're taking it off your hands. They're buying electricity, essentially. Exactly. And that could be a utility or it can be an industrial customer. That's an offtake.
Exactly.
And then you mentioned input. Input is like a fuel source, right? So I'm buying oil or diesel or whatever else, biomass stuff. That's the input, and the worry there essentially is that input, as we all know, oil, prices go up and down, gas prices go up and down. That price can go up and down, and so that's why the contract for the input is important too, to mitigate some of the risk on what your fuel costs are going to be, right?
Okay. Yeah, the way to think about it is banks are interested in determining a cash flow profile that looks pretty consistent over time. That's the whole game, because the more volatility there is, the more risk there is. And remember, the banks, they have no upside, right? They get paid interest and principal on time. That's their upside. That's the best they can do. Yeah. If you're an equity player, on the other hand, then you can assume a lot more risk in pursuit of a lot more upside. Yeah. So with the project finance in particular, what the banks are trying to do, and it is a bank market by and large, is trying to to identify, dimension, and then allocate the risk in the best way possible in order to get the longest term, stablest cash available for debt service. And then they say, okay, I have some coverage ratio on that and I'll be comfortable. Yeah. What goes into that is very elaborate, because not only do you need inputs in the energy business, you physically need the inputs. You also need the price of the inputs, right? So one of the things we always, and there's a great case I teach, which is the law of, Murphy's Law, anything that can go wrong will, right? And it's fun because students are like, oh my, how could that happen? So, well, in this case, there was a mine that was going to get built, but it wasn't built. And it was a coal-fired power plant. And by the way, not only was it not built, but the guys who were building it didn't actually have all the experience in building it. And by and large, even above that, they didn't have the money to build it. Oh my God. So, and if you read the offering memorandum and everything, it's fine. We got, the coals there, et cetera, et cetera. But at the end of the day, and in that case, everybody kind of missed the fact that the mine wasn't actually built, and that the financing for the mine wasn't actually in place. So you couldn't assume that this amount of coal with this spec was going to be at the plant in the time frame.
I see. So people were looking at the project from the building the coal power plant side, but they didn't go all the way upstream to double check on where the fuel is coming from and to see if all the infrastructure was in place to support the input. That's fuel
exactly source. Right. And so there was a coal contract. It hadn't quite been signed. That's a red flag. But when you really dug into it, it's like, yeah, but these guys were small coal miners and there was a reserve there. But, they were going to double their production. Who knew that they could do it? Technically, if you will, probably not that big an issue. But more importantly, where's the money coming from?
And isn't there or shouldn't there be a checklist? How like pilots have like a pre-takeoff checklist? Make sure that the wheels are pumped up. Shouldn't there be like a project finance checklist where it's like make sure the mine is built?
There is, and lenders are very sophisticated about this. As I say. The thing about a project financing is, you're financing a development project. So there's basically dirt when you start, and there's a library full of contracts. And those contracts are meant to establish both the physical and the financial volumes, if you will, and flows. And so, normally there's a tremendous amount of work goes into these things in terms of articulating the specs, et cetera. As I said, the EPC contract, I can't build it.
And EPC, just to break that out for our audience, EPC stands for Engineering, Procurement, and Construction.
Exactly.
And this is like an engineering firm that'll serve as like the general manager of all the things to get a project physically built, correct?
Correct. So then there's lots of offshoots in terms of operating later, but basically the EPC contract, you want one of the big engineering firms, with a credit rating,
like a Bechtel, a Fluor,
exactly.
a Jacobs. These are all big engineering firms.
Exactly, Siemens. Exactly. Bechtel and Fluor are the big ones. And you want them to step up and say, yes, we're going to provide you this, 2,000 megawatt coal-fired power plant with this heat rate at this time for this cost, period. And then there's obviously a lot of negotiation around the sides, but for lenders to move forward, they want to be sure that that EPC contract is with a creditworthy party and covers time, specs, and cost. And they don't want to assume a lot of that risk.
Yep.
All right. So there will be provisions for cost overruns and sharing, et cetera. But basically, at the end of the day, if you think about the lender, they want certainty. And the one thing they really want certainty is this thing can be built on time for a price and have the specs that match. And so any variance that goes in this case I teach, there's obviously a new technology and everybody thought it was going to work and it didn't. They're going to want assurances for that. And then the contracting company, it should be, the more technical risk there is, the more there's going to be negotiation around what the actual terms of the EPC are.
And what is a common type of assurance when you're dealing with a riskier project? You're bringing in a new technology and they need some extra assurance. What form would that assurance take?
There's a couple of different ways you can do it. One is you have undertakings by the contractor, say the Bechtel or the Fluor. Then if there's an outright money good guarantee that this thing will be there, that's fine. The banks will certainly accept the credit risk. There are provisions that in case of cost overruns, who actually picks them up. There are at the same time liquidated damages. If the project isn't on time, it's delayed, the banks will have insurance at the same time. So there are various mechanisms that are trying again to allocate the risk to those parties that can bear it the best.
And what is a liquidated damage? Is that like if everything goes up, you got to sell all your physical stuff, liquidate it, and then get some money for it? Is that a liquidated damage?
Well, it's not actually quite that, because you don't want to, the banks can assume the project as well, because they'll have all these contracts are conveyed to the banks in the case of non-payment or default. But what liquidated damages are, say you're not done yet. You ought to be done, and this will be completed as of this date for this price with these specifications. And specifications are important. The heat rate's important in a power plant. If for whatever reason you're not there, then you sort of go into this position where liquidated damages say, okay, if that's not done, then the contractor will pay into the project liquidated damages of X dollars a day or some mechanism.
I see. So it's kind of like a financial penalty if you're not keeping up to the terms that you set forth in your original contract.
That's right. Now it's never going to get, it'll be capped at some level because the contractor doesn't want to give an open-ended. So that's a negotiation, but it's sort of the first line of defense to how to make the project money good at that point.
I see. So this is like a form of like incentive structuring to make sure that the developer, the EPC, they're acting to the best of their ability.
Yeah, and there are real risks. I've been involved with looked like a very straightforward development project, and it was a technology that was not new but newish, and it just didn't happen. And so then you get in this discussion about, okay, whose fault is it, right? Yep. And it's not the owner, because in this case the contractor said, we will build this plant for you to this spec at this time for this amount of money. Liquidated damages only go so far, and then you get into, okay, what are the terms of the contract, and litigation, et cetera, can start to say, okay, who's going to clean up this very unfortunate situation in this case. If it's just a matter of time or tweaks or something happens in the system of supplies coming in or something, that can generally be worked out constructively.
And you mentioned not new, but newish. Can you kind of walk me through from like the eyes of a bank or the eyes of a project developer, what is, the range of like innovation that is permissible in new projects? Like what's a standard cut and dry project, and where are then you towing that line? And then where have you gone into like, this is a totally new technology?
A lot depends on what part of the energy spectrum you're talking about, but say in power, right? There are various technologies that develop over time. We've been building coal-fired plants for a long time. Not for a long time have we built one, but there can be some new technology in terms of the burn or the carbon emissions, et cetera. Better technology, things that are a variation on a theme. The contracting partner is probably going to feel pretty good about stepping up for that. I think the banks are going to, the banks don't want to assume any technology risk per se. It's kind of like the oil and gas business. The analogy is if you're drilling a well and there's 1,000 wells around it, all of which we have all this great data, all of which we've been producing for a long time, it's pretty easy to say, okay, anecdotally, I think this well is going to perform like this. Yep. That's really good. Yep. In absence of that, a run-of-the-mill technology, say, okay, it's been done 1,000 times. These guys did it. They're creditworthy. That's going to be very comforting. If it's a variation on the theme, it's still different. And the banks don't want to assume a lot of that risk because they're not in the risk business. If you were going to assume that risk, say, okay, I've got a little technology play here, then I'm going to, I'm much more of an equity investor at that point in time.
I see. So back to your earlier comment, the banks, they get all these special privileges, they get these assurances, but they also, and they don't make as much money. They have a very fixed amount of money that they're going to make if the project is successful, and they don't want to take a lot of risk. That's on the bank side. But the advantage of getting money from a bank is that the cost of that money is less relative to what you would pay an equity investor. Is that correct?
Oh, far and away. And even more than just an equity investor who's looking for much higher returns. There are, innumerable situations that you can say take a small oil and gas company, right? Probably isn't particularly creditworthy, certainly in today's world, to a bank and on a balance sheet basis. Would I lend Brett Oil and Gas $100 million so we can go develop the field? The answer, and based on his balance sheet and his credit and goodwill and handshake, and the answer is maybe not. In today's world, definitely not. Historically, the banks, however, have said, what I will do is I will lend money secured directly by the portfolio of oil and gas assets that Brett controls. And so there's this thing called an engineering report. And you get a professional engineer goes in there, in this case, DeGoyle McNaughton, Ryder Scott, evaluates the data, evaluates the history, evaluates all the geology and the geophysics, and says, we think these reserves are going to produce along this level, and then you discount all the cash flows back. And the banks say, great, I'm secured in that. I feel very comfortable because the volumes are going to be there. The costs are established based on precedent, and I'm probably either directly or indirectly going to hedge prices, in which case I'm willing to lend not some money, I'm willing to lend more money on a secured basis, like a project financing where you're lending to nothing to start off with. You're lending to a bunch of contracts. I'm willing to advance more money there than I would to the owner of the project himself on a balance sheet basis.
I see, because nothing is perfect, but banks have a lot of money and they spread the risk across many different potential projects, just in case some perform, some don't perform. Is that right?
But the real thing is, if you're secured and you're in a project where nothing can come outside that project, right? So the dividends come out, everything that operates in that project, that's you, and you're first in line to the cash flow.
I see.
So you say, okay, if I'm first in line for my cash available for debt service, and I'm comfortable that I've addressed, dimensioned, and allocated the risk on top, price, inputs, outputs, environment, all that's going to be taken care of, well, then I'm willing to lend, it depends in particular on what your offtake agreement is, but if you have a take or pay contract, right? with a credit-worthy, called a utility, take or pay contract, with a credit-worthy utility, the banks will say, great. I've got single A or double A risk for my revenues. I'll lend, 70, 80%.
I see. So you mentioned this concept of first in line. So walk me through that a little bit more. So a project, takes in money, it builds something physical, and then the engine starts humming. It's producing energy, someone's paying for that energy. And then based on the money that comes in, now whoever owns that project has to start paying back out money to all the people who lent him money. And the bank, because they're offering, these better terms on their loan, are first in line to get a payout. So if there's, let's say, $10 million a year that's being paid out to all different types of investors, and the bank is entitled to 5 million of that, and maybe one year they only produce 8 million, the bank still gets its 5 million, and the next guy in line doesn't get his next 5 million. Is that right?
Yeah, that's exactly right. And the way it works is there's money that flows into a project. So there's debt and there's equity, right? And let's say this project's contracted and it's relatively straightforward. It's a CCG gas plant.
That's a combined cycle gas.
Yeah, gas turbine, right? So lots of technology. It's getting better. Been out there. And you've got Bechtel's going to build it for you, and someone's going to offtake it. So the bank says, geez, this looks pretty good. We've seen it before. Very comfortable with the guarantees from the EPC contractor. We know we've looked at all the permitting, all the local laws. We understand where it is, how it operates. And we understand that we're going to be selling it to a credit-worthy party, the power. So we're not taking merchant risk, if you will. Merchant risk being selling a commodity into the grid.
Into a market where the prices may fluctuate.
That's exactly right. And hold that thought for a second. So we got this great project. Everybody's in the bank say, we're money good. We'll lend you 70 cents on the dollar. So 70 cents of debt goes in from the banks. It's senior, secured, right on top of the heap. Nobody can get to, it's the highest part of the capitalization in terms of credit perspective. And it may have some debt below that, subordinated. And then you get to the equity, which is waiting outside the ring fence for any kind of return. So you got to go through what's called a waterfall, and literally you negotiate this waterfall. And it says, okay, there will be revenues from the project. Price times volume, less cost. It goes in. What do? You have to pay your operating costs first. You have to pay your, anything to keep the project alive first. You have to pay your interest. You have to pay your principal. Then there'll be a series of provisions that the banks will require, like a debt service reserve that says, hey, if there's a little extra money in the early years, let's put that away for a rainy day. And that'll come out of this waterfall. It literally is a waterfall. Just watch the money keep flowing down. And then you say, okay, project's there, reserves are funded, et cetera. Interest and principal of the banks. Number one, interest first, then principal. Then if that's all settled up, then you go down to the subordinated debt, say, okay, interest on the subordinated debt, right? Principal probably going to be way out in the future. That goes well. Then you go and get down to the bottom and says, as I like to say, what's in the cash register at the end of the day? Then there'll be some provisions that it can or can't be dividended out to the equity. But the equity is the last guy in line, right? First guy in line is the banks, and they're looking for their interest and principal.
And who comes in for subordinated debt? It sounds like they're not getting as good a deal as the primary debt lender. Why would they get in on the deal?
Well, it's it's like anything. It's all about risk and reward. So the banks are going to get a floating LIBOR plus 2 or 3 or some number, and those markets change, but they'll get a return. They'll make some fees up front, and they'll syndicate the loan. So this is their business, and they're very happy with it. Beyond that, it says, okay, if we need more capital, the equity returns are going to be really high. If there's you think of it as an infrastructure investment, right? So we're not taking a lot of market risk. This is new esoteric stuff. We're not drilling up the next great shale play or anything. We're basically building a power plant that's going to produce electricity and sell to the local utility. If that's the case, then you've got infrastructure investors that say, hey, I'm a fixed rate player. I'm not a floating rate player like the banks. And I'm looking for double digit kind of return, maybe with a little upside if things work out. But I'm willing to put in, subordinated or preferred stock or some junior security because that kind of return to me is pretty good. I'm feeling okay. Then I've got the risk perspective that my 10% return will look great. Or if it's got some kind of a kicker.
And how is subordinated debt that different than an equity player if they're looking for a higher level of return, but also willing to take on more risk?
Big difference is in a debt security, in the case of a institutional piece of subordinate, will have interest and principal payments made, and if you don't make them, you're in default. You gotta make those, okay? If you go down to preferred stock, which is sort of almost a hybrid, you have a designated payment to be made, but if you don't make it, you can accrue it. So it's more equity in that standpoint that you don't collapse and go bankrupt, right?
I see. And they get even higher interest rates.
They should, but they'll also there's some tax treatment, but they'll also, in equity's case, you can take your dividend out, or if it's actually still in the company and the company grows more quickly, you want to kind of own the equity over time. That's compounding that much more quickly, if it's growing, if you will. Nobody wants a dividend from Amazon. Everybody wants to, another 300% of growth.
Yeah.
Right. And then banks, by the way, the only thing they're going to lend to an Amazon is, the receivables of the inventory, or, the data center that's secured in some fashion.
Got it. So, okay, we've been talking a lot about, the basic structure of these projects, which has been amazing. Tell me just more about this type of stuff you've been involved in through your career. Is it primarily energy-related infrastructure?
I worked on Wall Street running investment banking businesses for the likes of, Kidder Peabody and Citi and UBS and others, Bear Stearns, for about 25 years. And then I was in the private equity business for about the last 5 or so. So most of what I have done is really more in the public markets. So dealing with, stocks, bonds, convertible securities, which is a hybrid security, which has a debt instrument, but also an equity play. And then I started off doing project finance purely at a bank. What's happened in the energy business is, as I tell students, it's the largest business in the world. It's most interesting. It's most complex. And it does have these very articulate financing strategies developed because you finance the assets themselves, right? And so, leverage buyouts became a notion. Well, every guy in the oil and gas business is taking his net worth and putting a hole in the ground secured by, the revenues from that. Well, bootstrap finance is kind of the background of the LBO. All the securitizations that you've heard about, CLOs, CBOs, CMOs, that's really a perfect reserve-based loan. Right? Energy business, you have that reserve report. It tells you what the expected production is. You have a view on price, or you hedge. You know what the costs are, the development costs. You sit down, make a bunch of adjustments and metrics to constrain your risk from different perspectives. And then you say, great, that's, we'll lend you 70 cents on the dollar or whatever. That's kind of, securitized financing. So that all comes together. The markets themselves, ebb and flow, as do energy markets. As we like to say, when they're good, they're too good. When they're bad, they're too bad. Right now, it's very interesting because in the upstream oil and gas business in particular, the drilling side, the oil and gas business, there is tremendous pressure from both institutional investors and equity owners to reduce carbon emissions in general. But if you're a money center bank, historically those reserve-based loans have been a big part of your business. You're under pressure just to reduce the aggregate outstandings. And what that's led to is a real drying up of capital, especially in these shale plays. And the shale plays were go, and it's remarkable what's happened in the United States in terms of production.
Well, in the last 10 years.
Oh, the last 10 years. The great story is, step back, there was a Shell engineer named Huberus in 1958 or so. He came out with a theory that's called Huberus Theory. And it basically says that for any natural resource reservoir, there's a production curve that's basically bell-shaped. And it's a finite reserve. And so you put money in and capital goes in and production will go up, and then ultimately it'll just come back down because it's a finite reserve. And he plotted this curve, and he predicted in the late 50s that the U.S. Would hit peak oil production, I think, in 1970. 1974, the U.S. produced a little over 10 million barrels of oil a day. By 2008, the U.S. produced less than 5 million barrels of oil a day. And then you discovered the shale.
Yeah.
And so at the beginning of last year, we actually, as a nation, produced 13 million barrels of oil a day.
Wow.
Making us the largest oil producer in the world, as well as the largest natural gas producer.
Because natural gas is found in the same places as the oil.
Yeah, it's the same. Yes, but they're different. Historically, gas prices were regulated. It was a byproduct. Nobody wanted it. Nobody knew what to do with it. There wasn't all the pipeline infrastructure. So if you drill an oil well and you found some gas, you're like, then that's not so good. What's happened is the gas business has just exploded, and it was really the forefront of hydraulic fracturing, or combining hydraulic fracturing with horizontal drilling. And so reserves production in the United States, it's unparalleled what's happened. And then that technology kind of morphed over to the oil side, and it's been easy, it is as pervasive. So now we're able to produce all this. Huberus was wrong. And the reason is that we've always known the reservoirs had these reserves in them. The shale, people think about, there's a great analogy when you drill conventional wells versus shale wells. So a conventional well is kind of like drilling into a jelly donut, right? You get in there and you stick in the middle, you're vertical here, and then you get all the jelly around the hole, right? And you perforate your well bore, and then all the jelly comes in and goes up. The shale plays are much more like tiramisu. They're a series of strata, right? And these different plates. And rather than drilling in the middle and then pulling the jelly out, you actually come down, 7,000 or 8,000 feet, and you turn sideways. And as I like to say in Antero, where I sit on the board, we drilled 15,000 feet sideways in one day recently.
Wow.
That's 3 miles underground.
Wow.
And so you can imagine when you're going this way, the strata that you're in can be a whole lot less robust or large because you're perforating it all the way along.
So the change in technology in around the 2010, a little before the 2010 timeframe, around 2010, changed the economics and the interest in different types of land that maybe wasn't as useful before, but also the fuel supply. All of this shifted, led to rapid growth of this industry. I mean, shot up the U.S. economy in many ways. But now things are different. Things are slowing down. You're saying it's harder to get capital. It's harder to invest in new projects.
Yeah, there's really two big drivers. When you discovered the shale, the model was go drill it. And so that engineering report that I talked about, the banks have always lent against the proved reserves. Mm-hmm. Different categories: proved, developed, producing. It's actually coming out. Proved undeveloped is, we know it's there. We know we can get it. It's going to cost some money. And so banks will discount the PUDs more than the PDPs. When the shale came around, there was no current production because it was all new. So you couldn't finance just the PDPs. With the PUDs, you had to kind of get out a little bit and say, okay, there are probable reserves.
Well, sorry, what are those two acronyms that you were saying, PUDs and PDPs?
It starts with proved reserves, which is an engineering standard. And basically, while it's all numerical, it is a qualitative standard because it's an estimate of the hydrocarbons, oil and gas, natural gas liquids that can be produced at a point in time from a portfolio of oil and gas reserves at today's prices, today's technology, and today's regulatory environment, and today's costs. So it moves over time. When prices rise, reserves rise in net of production. When prices fall, reserves fall. When you start the shale phenomena, it's absolutely fascinating. In the United States, gas prices crashed. Oil prices crashed, 14 going into 15, 16. So you have 30, 40% decline in prices. Reserves in the United States went up. And it's because the technology was changing, the experience was so much greater that your knowledge of the commercial properties of the reserves themselves was growing. And so you say, well, yeah, prices are down, but I can develop this much more reserves at these prices. So it is, from a physical standpoint, it's pretty wild what's going on. What's happened in the industry is massive drilling, very liquid, tremendous interest in investment, private equity, the public markets, the equity markets, massive amounts of capital flow in chasing the shale, and production went from 5 million barrels a day to, north of 10. The shale is a short life, so you got to keep drilling to go, right? And so that tiramisu, you got to keep drilling wells to keep that going, to get your share of the cake. And there was no big return coming back in terms of free cash flow. Basically, people were issuing more debt, issuing more equity, growing the company that way. Then prices moved, OPEC plus or whatever. And, the industry really came under concern and say, well, what's the game here? If we're just keep continuing to throw more and more money at it and there's not anything coming back, is that really sustainable? Yeah. Then you got into, and that was really the debate that came into 19. And as you turned into 20, the industry was reconciling to, we need some kind of return. It's not just chasing growth. And the private equity firm would buy some, acreage, put together some more acreage, and then flip it for 3 times the money because everybody was going like this. And said, now this is actually, if it's going to be manufacturing business, we got to see some cash on cash return. So that was the start of 20, and then you had COVID, which, basically eradicated demand to a substantial.
So there was already a concern of oversupply, which was making people worried about getting their returns back because prices, were low. And now with COVID, demand also dropped, which doesn't help the situation.
No, not at all. Well, and remember, in the middle of last year, for reasons that, are beguiling, OPEC plus basically turned on the spigot. So you're facing COVID, demand was eradicated, you had this massive flow of product, and oil prices literally went below zero in the United States in Cushing. So what's happened is the industry, in the energy industry, is incredibly resilient, right? When prices go up and there's peak oil and OPEC was going to, prices went up, technology changed, we drilled up the North Sea, the Gulf of Mexico, and prices then got back in balance. Prices went down. You take some players out. But what happened in the shale is, as bad as tough as it was, and you had a big price spike at the end of 14 going to 15, 16. And then you had, basically 19, but really going into 20. So, yes, you had bankruptcies and the like. The first time it was accompanied by a lot of liquidity that was still in the business, hedge funds coming in saying, I'll put up my debt, maybe I'll end up with the equity, but I still believe in this. This time around, there's no liquidity. And it's really a function of a couple things, that post 15, 16, the returns didn't come because the model hadn't changed. And so the model is changing. There is, valuation wise, prices are still pretty beat up. So, people have lost a lot of money, and there's a resistance to it. And then importantly, you have the global universal conversation around climate change, which has become more polarized and has led to, discussions not so much about adaptation and, the transition over a period of time, but, we're going to abolish fossil fuels. And so today, as we said, the banks in particular, financial institutions, and it's across the ESG perspective. Right?
And ESG stands for environmental and social governance. Is that right?
Exactly.
And that's essentially, that acronym, essentially what that means is that companies or banks, which are companies, are trying to market themselves to their customers. They're trying to say, hey, listen, we care about more than just the single bottom line. And so we are going to adopt a series of practices that actually will affect our business to prioritize and value ESG, environmental and social issues. And a lot of that's really just environmental issues.
Well, it's changed over time. It started out, governance was a big part of it originally. Then, as boards were changing complexion alike. And the environment has risen to the forefront. And so, Larry Fink's out saying, we're going to invest our $7 trillion and we're going to look at this and we want to know what you're doing about it. And if you read the fine print, it's not calling for the absolute abolition, although you do have these very strong views about fossil fuels that are forcing behavior. So I think it's fair to say, the banks are, in retreat. Some of them had to get in retreat because the economics were so bad in the crash, so Texas banks in particular. But the big money center banks are under pressure to reduce outstandings to the upstream business. Yeah. That has led to almost an existential crisis in the oil and gas business, which is, we've done all this stuff. The technology has been unbelievably, developed. Yet, we're now in the penalty box somehow. And that's what I think we have to.
But doesn't this create an opportunity, though, for lenders who don't have an ESG focus now to have less competition for their deals? I mean, I can't imagine that every financial institution is putting such a big focus on ESG, especially because, it's politically, divisive, and, different banks and companies have different political alignments. So tell me, doesn't that just create an opportunity for half of the financial institutions?
It could. And in the past, you've had, more institutional money, hedge fund money in particular, fill up some of this need. As I said, in the crash, 15 going into, or 14 going into 15, 16, hedge funds came in the big way. More junior securities, they could own the equity, et cetera. But there just today is a real lack of interest, if you will.
And is it also possibly because, this has been a steady march, especially on the climate topic, it's been a steady march of not just public interest, but governments making specific regulations and policies that follow the public's will, and that maybe some of these banks might see it coming, where they want to get on board the ESG train, so they don't find themselves caught with their pants down when regulations might change. Is that part of it or no?
I think it's part of it. And I think the move to ESG. I chair the Antero ESG committee. I don't think anybody's in denial, and I think actually it's a very good thing because the issues of E, S, and G need to be addressed. And part of it's just communicating, what's going on, what's actually doing. So environmental standards, I won't give you the whole thing, but Antero does a great job. So part of it's getting that story out there, and then part of it's also, and I think this is where it gets interesting, is you have to develop the narrative around your business, right? So, if you're it's very difficult to embrace the outright, some of the stronger proclamations about the evils or the right and wrong of the oil and gas business, for instance. Because if you're looking, over a longer term period, we really have two goals, I think, as a world, as a community. And one is we want to eliminate or radically reduce carbon emissions over time, but at the same time, we want to continue to have ample supplies of energy and reasonably priced energy in order to continue the development of the world. And if you look at the two, those have to be in harmony.
Right.
And those two in harmony then say, okay, now we can actually deal with the heavy lifting of what's the physical parts of the energy paradigm that we're going to endorse, how's that going to work, what are the implications of going in one direction or another, which is vastly complicated. But if you hold both those goals in mind, then I think you get to a solution that says, okay, we need to continue to evolve. And, I think the upstream business will have a very important part to play in the energy in an awfully long time.
Okay, so let's talk about this evolution and where you see things are going. Specifically, in the world of project development and project finance, as we start taking the ESG concerns more seriously, as we start entering into the clean technology revolution, as some are calling it, how does this impact the finance world specifically? Are new structures being put in place, or is it just clean infrastructure, different technology but same story, or is there more a profound change happening?
I think the profound change is where people are being directed into these different markets for for lack of a better description, political reasons. All right. So there is pressure on, really scrutinizing your outstandings to the upstream oil and gas business. Right? And that's without, looking at the specifics of any one company. The coal business in terms of steam coal, right? Every bank that's out there said they're not going to lend to the steam coal business, just as a matter of policy. And, coal-fired power is a lot dirtier than natural gas-fired power, twice as dirty. And the renewables obviously have no emissions. So I think, separating the politics aside, there will be different areas of influence. I personally think the ultimate solution is going to involve the evolution of each part of the paradigm. So I think, longer term, natural gas, I'm pretty sure anybody who's, involved on the physical and the political and the financial side would argue gas is going to be around for a very long time. And it really is, in some ways, the backbone of the renewables because they are intermittent. Where you're seeing investment change, this is not so much the lending structures are pretty much the same. And so better projects with better participants with stronger terms will get better financing, et cetera. But, in terms of equity investment, venture capital, there's some big looming issues under the climate change banner that are going to get a lot of attention. Battery storage, absolutely. If you could crack the code, that could be a real game changer. I think you'll see a lot of interest in hydrogen over time. We're at the same time, I like to think that we'll continue to pursue carbon capture, use, and storage, CCUS, because whether it's in the effluent coming out of a power plant or the effluent coming out of a cement or a steel making facility where there's a lot of CO2 being released, if you could develop the technology at the right cost and either take carbon out but then put it someplace, and after all it did come from the ground originally, I think that can be really game changing in how we get the whole thing to kind of morph into something that's more compatible with both economic development and these climate change goals.
Yeah, I couldn't agree more. I've never understood the criticism against carbon capture from the environmentalist side. It's like, yes, you've correctly identified the problem. We're emitting carbon into the air. And then so here's a solution to that exact problem that you've identified. But for them to then go say, well, no, now this is giving people, a license to, continue, burning fossil fuels. Well, yeah, burning fossil fuels isn't the problem. The problem is the carbon going into the air. So maybe you just don't like those companies, but let's get serious here. Let's try to solve problems. Let's not just try to, promote things that we emotionally like and discount things that we don't emotionally like.
I'm preaching to the choir. I think that's the root of such the argument. The other thing is, and by the way, if we take these emotional issues, right, or we just don't like something, is for perfectly understandable reasons in some ways, you have to think about, what are the implications of that, right? And, the global energy business is about as complex as anything that you can imagine. And, if you want to continue the development of the developing world in particular, but if you want to keep rising the standard of living in the developing world as well, energy is going to be the backbone of it, right?
Which, by the way, also when it comes to climate issues, the big issue there is that, climate change, it looks like the problem solving climate change is so astronomical. We're going to be dealing with climate change. It's almost just a matter of to what degree. And if what you care about with climate change is that it has disproportional impact on the poorest in the world, then the most important thing is to give the poorest people the resources to adapt to it. And that only happens through cheap energy.
Yes. It's very interesting. So, we also in energy are gifted with wonderful government-sponsored research and the like. I mean, I don't know any other industry that has the Energy Information Administration of the United States or the International Energy Agency for the OECD countries. But this is as good as it gets in terms of data accumulation and bright people studying these. And they have projections. And what we know about projections, as I tell students, is we know one thing: they'll always be wrong. But they are, they're grounded in the assumptions that, in the case of these guys, about today's at today's technologies, today's prices, today's costs, today's results. The IEA predicts we won't be anywhere near getting to that 2% cap in
not even close.
Emissions. Not even close. If you look at their, I think it's called the Sustainable Development Scenario, the SDS, which is aspirational. Technology doesn't exist today, but it's aspirational, incredibly well, directed, thought through, and the like. You still have fossil fuels, north of 40, maybe even close to 50% of the primary energy in the world in 2040. So I think what we need to do is we need to take some of the emotion out of the discussion, understand where we want to get to, right? And understand that it can't be sustainable if it's not feasible. And it can't be feasible if it's not commercial, because it's not going to get financed.
Yeah.
And then let's figure that out. So somebody's got to pick up the onus. Now, if the world decided to go, governments could, just make declarations, and they could, arrange the financing or the investment. You could go there. I just think the hurdles are large, and the discussion needs to be very calibrated strategically to this intersection between sustainable development, growth, economic development growth, and reducing carbon emissions. And the win-win is when you get all that moving in the right direction. If you drop off one of those pieces, then you will have failed.
Yeah. So Brooks, as we wrap up this conversation, can you, we've talked a little bit, we've talked about the past, we've talked about how things are transitioning now. If you could look forward into the future, 5-10 years, what are some areas that we should all be keeping our eyes on that are exciting, new, emerging areas for project finance?
Well, projects will get financed to the extent they comply with this notion of risk identification and allocation. The capital will go there, and project finance in itself, banks come in and come out all over the place. So I think the areas that are most interesting, I think battery storage, because if you could solve battery storage, then the intermittency of renewables is, certainly reduced. And if you could actually get that battery storage to work in harmony with the grid, then you'd have, what is ubiquitous intelligent grid. Whereas now, it's kind of the old model where we produce a lot of energy, send it on the grid, and it goes one direction. And, you have to sell it the moment you produce it. So I think battery storage is very important. I think CCUS is a really important idea because it addresses not only capturing CO2 from power plant emissions or from steel making and cement, which are very CO2 intensive, but in the past, what's hard is that CO2 is then recycled back into oil and gas properties, where if it's an older field or depending on the geology, a lot of secondary recovery has to do with pushing things back into the ground to move the hydrocarbons to the wellbore and produce hydrocarbons, in this case being the jelly or the jelly donut. And so those EOR projects, there are a couple of them tried. That would be really interesting if you could not only capture it and store it, but use it. I mean, that would really be interesting, right? And so I like that.
Brooks Klimley, thank you so much for your time, your insight, and look forward to talking to you soon.
All right, Brett, thank you very much.